go ahead and get started.
Yeah, go ahead.
Well, yeah, welcome everybody. We are from SVA, Certified Public Accountants. SVA, it's a regional accounting firm. We have locations on the west side of Madison and in Brookfield, and we specialize in working with closely held businesses and their owners. We provide a wide array of services to our clients, including accounting, bookkeeping, tax and assurance services, but also a multitude of consulting and advisory services as well. We work with a wide variety of industries, including real estate, healthcare, manufacturing, hospitality, construction, and nonprofit. I'm Molly Taylor. I'm a senior manager in our tax service line at SVA, and I primarily work with corporations and the manufacturing, hospitality, construction industries, and also their shareholders, providing tax services and tax planning throughout the year. And with me today is Nikki Grauloff and Rachel McAlexander, and I'll let them introduce themselves to Nikki. Do you want to go first?
Sure. Good morning. Nikki Grauloff. I lead our hospitality industry group. So that's anything and everything you do to have fun falls within there, and a wide array of other closely held businesses, and really focus on the tax and consulting side of the business.
Hi, I'm Rachel McAlexander. I'm a principal in our tax service line. I work primarily with manufacturers, construction companies, and a smattering of other industries. I'm doing similar things to what Nikki does, a lot of tax consulting and compliance.
And then Megan, did you want to say anything as well before we get going, or you're good to go? I think you're on mute, Megan.
Yep, I see that now.
Yeah.
Thank you. I'll keep it short. I'm the interim executive director right now at Dane by Local. Really grateful for you all for doing this and allowing us to record it so that we can hopefully touch as many people as we can within our membership. And I think that's all I have to say.
We'll go ahead and get started then. Just to lay a little bit of groundwork too before we get into the meat of the presentation. So the One Big Beautiful Bill, it was passed in July of this year. It has a lot of different provisions in it in relation to taxes, and we're planning to go over a lot of them today at a very high level. Your situation is at both the individual and business level, the type of change under this bill that's going to apply to you. Throughout the presentation, we're going to refer to the One Big Beautiful Bill as OBA. It's just easier to say than One Big Beautiful Bill. Clarity on what is changing and what is not. We'll also regularly refer to the Tax Cuts and Jobs Act, or TCJA as we call it, major tax overhaul that occurred before OBA in 2017. I have a lot of content to cover. We'll ask that we save questions until the end. If you want a question in the chat, and if we don't have time to answer it at the end, we will plan on following up with you after the presentation. Diving in, we're going to start off by just talking about some changes in regards to individuals. First, we'll talk about some provisions under TCJA. Under OVA, so starting off with individual income tax rates, TCJA reduced the individual income tax rates. The bracket went from 39.6% to 37%. Tax rates were set to revert back to what they were before TCJA in 2017, but OVA has now made those tax rates permanent, indexed for inflation as well. The standard deduction under TCJA was significantly increased, so much so that about 90% of taxpayers in the US claim the standard deduction instead of itemizing, just because the standard deduction is more than what they would claim if they did itemize. That standard deduction was set to revert back to what it was before TCJA, but has also now been made permanent under OVA. Exemptions, those were suspended under TCJA. They were set to come back into play starting in 2026, but they have now been permanently terminated. The child tax credit under OVA has been increased to $2,200 per qualifying child. This is a permanent change as well. And the phase out thresholds for this child tax credit have been made permanent too, where if you have over $200,000 of adjusted gross income as a single taxpayer or for taxpayer, you will start to be phased out from being able to claim these credits. The other dependent credit, which is a $500 qualifying dependent credit. So think of if you have a dependent at home that's over the age of 17, or maybe you're taking care of elderly parents, you can qualify for this credit. This credit has been made permanent under OBA. Alternative minimum tax, under TCJA, the exemption for alternative minimum tax was significantly increased, so much so that a lot of taxpayers are no longer subject to alternative minimum tax. The higher exemption was set to expire after 2025, but has now been made permanent. So taxpayers, for the most part, will continue to not be subject to alternative minimum tax. And then the estate and gift tax exemption under TCJA was also significantly increased. It was set to revert back to what it was before TCJA, but OBA has made that higher exemption amount permanent. For 2026, that amount. So just a summary slide here of how these tax provisions being made permanent are going to impact you as a taxpayer. A lot of this in general is going to be pro-taxpayer. It'll help taxpayers save money on their taxes. It's also going to provide some clarity in regards to tax planning. Now that we know that a lot of these provisions, we weren't sure if they were going to sunset. Now we know they're being made permanent. It just adds clarity in regards to what you want to do this year and maybe what you want to think about in the future as well in regards to tax planning. I just want to clarify too, when I'm saying that something has been made permanent, what that means is it's not set to expire or sunset. It doesn't mean that it's not ever going to change in the future. It could still change if future legislation is passed, specifically changing some of these items. Now touching on itemized deductions in relation to individual taxes as well. One of the big things to come out of OBA was this increase to the state and local tax cap for itemized deductions. Previously under TCJA, you could only take $10,000 of an itemized deduction for your state and local taxes, no matter if you had more in property taxes, real estate taxes, or income taxes. You could still only take a $10,000 deduction. That amount has been increased to $40,000 for 2025, and then is set to be increased as well a little bit each year through 2029. This is not a permanent change. It will revert back to a cap of $10,000 in 2030. And there is a phase out that's going to apply for individual taxpayers that have an adjusted gross income over $500,000, where this cap will start to be phased down back to $10,000. The deduction is not going to drop below $10,000. So, mortgage interest deduction. Before TCJA, you could claim an interest deduction up to $1 million of acquisition indebtedness. TCJA reduced this to $750,000. This was set to expire after 2025, but has now been made permanent, the $750,000 acquisition indebtedness limit. Home equity debt for itemized deductions. Interest on home equity debt could not be deducted unless it was used to buy, build, or substantially improve a home. This was set to apply through 2025 and then revert back to what it was before TCJA, but has now been made permanent under OBA. Casualty loss deductions. These under TCJA have been limited to federally declared disasters through 2025. Again, set to go back to what it was before TCJA, but has now been made permanent. And OBA actually expanded a little bit upon these, where you can now get a casualty loss deduction for certain state declared disasters as well. Miscellaneous itemized deductions. Think of maybe before TCJA, you could take a deduction for tax preparation fees, brokerage fees. Those were suspended under TCJA. They were set to be reinstated in 2026, but that suspension has been made permanent. The piece limitation, which was a phase out on itemized deductions, that was suspended under TCJA. That suspension has been made permanent under OBA, but there is a replacement for it. This is going to impact taxpayers that are in the highest tax bracket, where their itemized deduction is going to be reduced by 2/37 of the lesser of their total itemized deduction amount, or the amount that their taxable income exceeds the 37% tax bracket. That may sound really confusing, but what it really means is that if you're a taxpayer in the highest tax bracket, which is 37%, you will not receive more than a 35% tax benefit on your itemized deductions. And charitable contributions, those are now going to be subject to a 0.5% floor. What this means is that if you are paying an itemized deduction for your charitable contributions, you have to have over 0.5% of your adjusted gross income in charitable contributions before you can get any benefit for those charitable contributions. I just want to mention that that will not come into play until 2026, along with this 2/37% cap. That also comes into play in 2026, so will not be impacting taxpayers this year. Again, just to give a summary of how these provisions are going to impact you as taxpayers. The state and local tax cap may want to start thinking of timing in regards to your real estate tax payments and your fourth quarter estimates. If you make fourth quarter estimates, where it may make sense to try and double those up in 1 year so that you can take full advantage of that increase to the charitable contributions now being subject to a 0.5% floor. With that not starting until 2026, there may be some tax planning opportunities where you may want to consider potentially front loading some of your charitable gifting in 2025 to get more of a benefit for your charitable contributions. And just to give an example, if we go to the next slide, I've got a situation here of a taxpayer that has adjusted gross income of $1 million, and they are charitably inclined to give charitable contributions of $100,000. In the first situation, under TCJA, it's pretty straightforward. They get a full itemized deduction of $100,000 for that charitable contribution, leaving them with taxable income of $900,000. And their tax savings on that charitable contribution is at 37% or $37,000. However, what's going to happen starting in 2026, the same situation where a taxpayer has adjusted gross income of $1 million. They have charitable contributions of $100,000, but they are only going to benefit of $95,000 as part of their itemized deduction for those charitable contributions. The reason being is that 0.5% floor, 0.5% of $1 million of adjusted gross income is $5,000. So they only get to take a deduction for the amount of their charitable contributions over that $5,000. And then with their itemized deduction being $95,000, they are only getting a tax savings of 35%. So breaking it all down, the difference between these two situations is a difference in tax savings of $5,600 in the first. Again, just trying to show that it may make more sense to front load your charitable contributions in 2025 if you are a charitably inclined person. And moving on to some new items in regards to individual taxes. There is going to be a new charitable deduction for individuals that are not claiming an itemized deduction. For single filers, this is going to be a $1,000 deduction. So if you make up to $1,000 charitable donations, you can claim a $1,000 deduction for that. For married filing joint, it'll be $2,000. This is a permanent provision. It's going to start after 2025. So can't claim it this year, you can claim it next year in 2026. And important to note that this is not going to include contributions to a donor advised fund. The enhanced deduction for seniors. This was something President Trump campaigned pretty heavily on a promise of no tax on Social Security. He wasn't able to get that passed, but what was passed instead was the $6,000 deduction per individual for taxpayers that are over the age of 65. This is in addition to the already existing increase in the standard deduction for seniors. And again, this is just a temporary provision. It will go away after 2028. There is also a phase out here. So for individual taxpayers with over $75,000 of adjusted gross income, they will start to be phased out from this deduction. The same if you can have over $150,000 of adjusted gross income. Auto loan interest deduction is also new this year. This is a deduction of up to $10,000 for interest paid on a auto loan used to purchase a new car. The car itself has to be a qualified personal passenger vehicle with final assembly in the US. Also included are all-terrain and recreational vehicles. This again is an above the line deduction, so you don't have to take an itemized deduction in order to claim this. And it's going to be temporary as well. Will be in play for tax years 2025 through 2028. And there's also a phase out on this as well. If you have, that's $100,000 for single filers and $200,000 for newly filing joint. So if you purchased a new vehicle this year, took out a loan to purchase that vehicle and are paying interest on it, you could potentially qualify for this new deduction. Wagering loss deduction also changed slightly here. Previously under TCJA, gambling losses were deductible to the extent of your gambling winnings, so that there was 100% offset. If you were taking an itemized deduction, OBA has changed this where gambling losses can only be deducted up to 90% of gambling winnings. And this is a permanent change as well. And just summarizing how these changes are going to impact you as a taxpayer. In particular with the charitable contribution deduction, now being able to be claimed even if you're not itemizing. If you are charitably inclined, give some donations every year, but have not taken an item in the past, maybe you haven't been keeping and retaining those receipts that you get for your charitable donations, but you'll want to start doing that again in 2026. Now I will hand it over to Nikki and she'll talk about compensation and benefits.
Thanks, Molly. So first we'll start off on the no tax on tips and overtime pay. So before tips and overtime were just taxed as normal. Now under OBA, there is some relief for years 2025 through 2028. So there's an above the line deduction, so individuals do not have to itemize to get that benefit. It only applies to income taxes. So the employee will still be subject to FICA taxes, Social Security and Medicare tax, as will the employer. And it will exclude highly compensated individuals, which is defined as 160,000 for 2025. So, and there's also a phase out. And a valid Social Security number is required. So specifically for the deductions for tips, currently under or prior under TCJA, there was no deduction. They were just tipped as normal. So now under OBA, there's up to 25% of tips are not taxed to the employee. Again, they'll pay their Social Security and Medicare tax, but then they'll get an above the line deduction for those tips. The tips have to be voluntary cash or charge tips. So some of the service charges that, hey, you know, a party of 6 or more dine, there's an automatic 20% gratuity. That actually isn't a tip to the employee. That's just additional W-2 compensation, so that would not qualify. And then it's limited to occupations where tipping is traditionally customary. The IRS is going to release some more information by October on what types of businesses, but hospitality and salons were specifically identified. So overtime pay, before overtime pay was just the time and a half was just taxed as normal. Now up to $12,500 per individual is not subject to income tax, but it's not the total amount that you made during those hours that you were working overtime. It's the additional 50%, the 0.5% is not subject, or the time and a half, the half, is not subject to tax. So right now we don't, tips do get reported on your W-2. Overtime does not get reported on W-2. In box 12 of the W-2, the IRS came out and said, hey, we're not going to change the W-2. We're going to include additional codes in box 12 to identify what those amounts are. So when individuals are preparing their tax return, they will have that data. So that's all great for tipped employees. The IRS is recommending don't change your payroll withholding now. So come time to do tax returns, any tipped employees or employees working overtime should hopefully have an additional overpayment that they otherwise wouldn't have had. Okay, moving along. So there was some changes in fringe benefits. So there's a qualified bicycle commuting credit. So up to $20 that the company reimbursed for employee wasn't taxable. It permanently removes this benefit. OBA now permanently removes this benefit starting in 2026. This is one that we didn't really see very often. Moving expenses were suspended in 2018 to 2025, and that was made permanent, with the exception of armed services in the intelligence community. Dependent care assistance, so that's allowing pre-tax dollars to go into your flex spending for dependent care. It increases the amount from $2,500 to $3,750 for a single, and $5,000 to $7,500 for married filing joint. I just heard on the radio this morning the average cost of daycare is $18,000. So this is just a little bit of that enormous expense. That if you have somebody in daycare full time, you'll probably likely use all of that. So this provision is made permanent, and it starts for years after 2025, so starting in 2026. One thing that we should mention is we got to be a little careful because some things start in 2025 and some things start in 2026. So the implementation date is really important, and it changes for all different aspects of this. And then the educational assistance program. So previously up to $5,250 was excluded from employees' income. And so now that's made permanent and adjusted for inflation going forward. So that's a great incentive. So really positives on dependent care, increasing that dollar limit and making permanent the educational assistance programs that employers provide to their employees. All right, let's look at credits and incentives. So paid family medical leave. So under TCJA, there was a credit for paying qualified employees while they were on leave. That was set to expire in 2025. That is now made permanent, and it also enhances the credit to allow insurance premiums and lowering the eligibility from 12 months to 6 months. So that's favorable for the employer and the employee. And the employer provided child care credit. So previously on expenses up to $150,000, the employer got a 25% credit. That increases to 40% or 50% for a small business with a max credit of $500,000, which will be adjusted for inflation. So a much more favorable tax credit there for providing child care. All right, and then we'll go to some of the administrative changes. So good news, 1099s. We'll start with 1099Ks. Probably not a lot of people on here issue 1099Ks, but before those, the reporting threshold was if you're over 200 transactions, you had to do 20,000, 5,000 in 2024. It was set to go to 2,500 in 2025 and then $600 thereafter. So that was going to make a lot of additional businesses required to do 1099K reporting or receive 1099K reports. Good news is now that increase from $600, what it was going to go to in 2026, up to $20,000 or over 200 transactions. 1099 NECs and miscellaneous. This will probably hit a lot more people on that call. Right now, it's any vendor or individual that you pay $600 or more for services is subject to a 1099. So you had to 1099 them. Now that amount moves to $2,000, but this is for years after years 2026 and thereafter. Okay, so we got to make sure our 2025 1099s will stay at 600, and then it's indexed for inflation. So that's really gonna, moving from that $600 to the $2,000 threshold is really going to reduce the number of 1099s that businesses are required to issue, which is great. And then the employee retention credit. So employers were able to file 2020 claims through April 15th of 2024 and 2021 claims through April 15th of 2025. And there was a 3-year statute of limitations on those, except for 5 years for Q3 and Q4 of 2021. So the IRS changed it. So if you're still waiting for ERC claims, they're not going to make payment of Q3 and Q4 2021 ERC claims if they were filed after January 31st, 2024. So if you're waiting for one of those, the IRS said those are not going to get paid. They're also looking to go after COVID ERTC promoters. So they want to increase the penalties on them. So those are individuals that filed fictitious claims. And it extends the statute of limitations to 6 years for both the IRS and the taxpayers for these credits. Good news for 1099s, ERC, some of those claims aren't going to get paid. So now some new items. So new item is something called a Trump account. Before we really didn't have any government funded accounts. Now a Trump account creates a $1,000 government funded account for children born between 2025 and 2028. So there's no income limits, the child needs to be a US citizen and have a social security number. Parents can also contribute to these accounts going forward, even if your child wasn't born within those states. If you have a child, you can also create a Trump account. It just won't get the government funded amount. But these accounts are not available until starting in July of 2026. So a lot of individuals that are having children now who will qualify to get the $1,000, they just need to wait till July 2026 until that will be funded. And the child can then access the funds at 18. It is subject to tax and penalties on earnings up to the age of 59 and a half. So it follows a lot of the IRA rules. And after that, only the earnings are taxable. And then if a parent does not open a Trump account for the child, the IRS will. The U.S. Treasury will open it. So that's all great. And we'll look at, well, what else was changed? What modifications were made within the OBA bill? So able accounts, if you were disabled before you were age 26, there was a credit and you were able to have contributions that tied to the gift tax exclusion. The able accounts were expanded. So now if you're disabled before age 46, you're eligible for able account. The increased contribution was made permanent. The savers credit was increased slightly. And then there's also a tax-free rollover from a 529 plan that's now allowed into the able account. So that was expanded and enhanced. 529 plan qualified expenses. So you were able to use 529 plans for K through 12 higher education, which was limited to $10,000 amounts. So now they expanded the use of 529 plans to include some post-secondary credentialing. So a lot of times, you know, in our world, that's our CPA license. There's a lot of ongoing, you need to get it and you need to continue to do education to credential it. Increased annual withdrawal for the K through 12 tuition to $20,000. And so these are all made after the enactment of OBA, which was on July 4th. So those are all currently present. HSA, there were some changes. The contribution limit was $4,300 for individuals, $8,550 for families. Generally, you could have an HSA if you had a high deductible health plan. And the qualified expenses were limited to what IRS defined as medical expenses. And then each spouse needed an HSA to make a catch-up contribution. So some of the changes that I'll maintain, some of the changes were it includes direct primary care arrangements, ACA bronze in other plans, and then more qualified expenses. So direct primary care fees, telehealth and remote weren't otherwise covered, and now they're covered before your deductible. So they enhanced what you could use your HSA contributions on to be more advantageous. I'll kick it back over to Molly for some more items made permanent.
Thank you. So now getting into talking about business tax changes. Specifically, we'll start with TCJA provisions that were made permanent. Kicking it off with 100% bonus depreciation. 100% bonus depreciation under TCJA was in play through what this meant is if you had a fixed asset purchase in the year, you could take 100% bonus depreciation and fully expense it in the year you placed it in service. This 100% bonus began to phase out starting in 2023 by 20% each year. So for 2025, bonus was OVA has put 100% bonus depreciation back in play for property that was acquired after January 19th, 2025. If you have property that was acquired and placed in service before January 19th, 2025, it will still be subjected to 40% bonus depreciation. The business interest expense limitation. This was something that was new under TCJA, where business interest expense was limited to 30% of adjusted taxable income. How ATI was calculated depended on the year. For 2018 through 2021, ATI was calculated as EBITDA, but for 2022 through 2024, it was calculated as EBIT. So losing the add back for depreciation and amortization, which meant that ATI was overall lower, and then the business interest expense that could be deducted was lower as well. Has now reinstated ATI as EBITDA. So we get the depreciation and amortization add back once more. Important to note here too that if you are a small business where your average annual gross receipts for the past 3 years is less than this business interest expense limitation does not apply to you or your business. The excess business loss deduction. Under TCJA, this was a restriction to business losses for non-corporate taxpayers. Loss cannot be deducted against non-business income. So for example, for a married filing joint, $500,000, that loss would have been disallowed in the current year and converted to a net operating loss that would have had to have been utilized in a future year. That has made this now permanent and has retained the existing version of the House bill. Through the House, they wanted to further limit this excess business loss. summarizing here, how this is going to impact actually your business. It's no longer phased out, so more opportunities to take a full deduction in the year you're placing service, but relevant for taxpayers. And experimentational expenditures. These were changed under TCJA. Previously, R&D could be fully expensed when it was incurred. And then starting in 2022, R&D needed to be capitalized and amortized. For US-based R&D, that was 5 years that the R&D could be amortized over. For foreign-based R&D, it was 15 years. This caused some significant cash flow issues. Oh, sorry. Hearing that, I'm a little bit hard to hear. Is this better? Okay, sorry about that. This was causing some significant cash flow issues for companies that were heavy in R&D because you're incurring these R&D expenditures, but not able to take the tax deduction for them in the year that you're incurring them. OVA has now passed and changed R&D back to the way it was before 2022, where you can take a full deduction for it in the year it is incurred. This is specifically just for US based R&D though. Foreign R&D remains needing to be capitalized and amortized over 15 years. And then the effective date for this depends on what type of business you are. For small businesses that have gross receipts less than 31 million, they can actually make an election to apply this change to 2022 through 2024. So if they elect to do so, they would need to go back and amend their 2022 through 2024 return to take a deduction for that R&D in the year that it was incurred. This needs to be done as well before July 6th of 2026, so less than a year now to make this election and go back and amend returns. And then for businesses that aren't considered small business or small businesses that are deciding to forego this election, there is still options for what to do with the R&D that was capitalized in 2022 through 2024. For amounts that have not been yet amortized, businesses have the option to continue to deduct that R&D on its scheduled amortization. Or they can choose to deduct the remaining amount in full in 2025 or deduct it equally between 2025 and 2026. So a lot of different options there, a lot of tax planning opportunities for businesses that have R&D and have previously had to capitalize it, where you may want to look at what you're expecting for income this year, what you have had for income in the past couple of years if you're a small business, and also what you're maybe expecting for income in the next couple of years too, in regards to how you want to treat your R&D expenses from 2022 through 2024. And just want to note too that this change to being able to fully deduct R&D expenses is now permanent, so it's not going to expire. And then the QBI deduction, this was a deduction of up to 20% of your qualified business income for certain trades or businesses. And this applied to owners of sole proprietorships, partnerships, and S corporations. Deduction was set to expire after this year, but has now been made permanent as well under OVA. The phase out range for this as well has been expanded, which potentially allows for more deduction for certain service businesses specifically, and also businesses that have lower fixed assets. And just summarizing how these tax provisions are going to impact you as taxpayers. Again, just want to reiterate R&D expenditures if you're a business. Determining how you want to treat your R&D expenses from 2022 through 2024. talking about some new and enhanced items in relation to business taxes. The section 179 small business expense, that expense limit has been increased under OBA, where it is now 2.5 million. What that means is that if you have a large amount of fixed asset purchases during the year, you can fully expense under 179 up to 2.5 million of those. The phase out threshold is also increased to $4 million. What that means, again, if you have a large amount of fixed asset purchases during the year, as long as you don't have more than 4 million, you're not going to be subject to a phase out on the amount that you can fully expense under 179. The type of property that qualify for this, that has not changed under OBA. It remains as tangible personal property, off-the-shelf software, and qualified real property. However, the definition of qualified real property, those have been expanded and defined a little bit more. So if we go to the next slide. This slide just summarizes what all falls under the definition of qualified real property. So similar to in the past, it includes qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property. In particular, OBA has further defined qualified restaurant property, where some items that in the past have not qualified as qualified restaurant property now do. On to the next slide here. Want to revisit 100% bonus depreciation, specifically in regards to qualified production property, as this is new this year. This is going to be advantageous for manufacturers that are maybe looking to expand, put a new building into service, where they can now fully expense what is considered qualified production property, whereas in the past that would have had to have been depreciated over 39 years. So qualified production property is defined as non-residential real property that's integral to manufacturing and production. It requires substantial transformation of property. And then to qualify for this, the construction would need to begin after January 19th, 2025 and be placed into service by January 1st of 2031. And there are some components of the construction that would be specifically excluded. That would include offices, lodging, parking, sales areas, R&D, software development spaces as well. It may be worth having a cost segregation study done if you are a manufacturer putting a new building in. Figure out what of those items of your new building are offices, lodging, parking versus what would be considered qualified production property, so that you can fully expense the qualified production property, if that makes sense in your situation. There is a 10-year recapture rule as well for this under section 1245. If use of the qualified production property ceases, where there would need to be income recaptured at ordinary tax rates. And then the business meal deduction, those have not changed under OBA, pretty much retaining what was already in place under TCJA. That's deductible for tax purposes, as long as they are considered ordinary business meals. So that would be food, beverage with a client, prospect, or employee, as long as it's not lavish and the taxpayer or employee is present. Entertainment as well remains not deductible. Again, summarizing how this is going to impact taxpayers. Main thing with section 179 is just increased opportunity for businesses fully expense assets that they're putting into service in a year. And section 179, I should have touched on this earlier, is a little bit different than bonus depreciation. There's a few different limitations with 179, but also 179 Wisconsin as a state follows, where it allows the full expensing of the fixed asset, versus Wisconsin does not follow bonus depreciation. That is just something that can be taken at the federal level, but not at the state. All right, I will kick it over to Rachel then to talk about some modifications to know.
All right, so let's talk about some noteworthy modifications here. The first one is qualified small business stock exclusion. And this really has to do with, if you have C corporation stock that you're selling, it qualifies, you can exclude that entire gain. It's a huge tax saver. So to be able to qualify, it has to be original issuance issued by a domestic C corporation. In the old rules, the corporation had to have $50 million or less in assets to qualify and also be engaged in an active trade or business. OBA increases the amount of assets to 75 or under, so it opens it up to more corporations. There's also a holding period requirement, so you have to hold that stock for
Going
5
somewhere?
years at least.
You going somewhere?
Larry, can you mute, please? Thank you. So if you hold that stock for 5 years or more, that's 100% exclusion. There are some old rules. If you acquired that stock before September 27, 2010, you're looking at either a 50% or 75% exclusion, depending on when you purchased it. Now, for stock purchased after July 4th of this year, you are eligible to get an exclusion, a partial exclusion if you sell before that 5-year holding period. So 50% exclusion for 3-year or a 75% exclusion for holding it for 4 years. There are limitations to how much gain can be excluded. Previously, that exclusion is the greater of 10 million or 10 times the basis in the stock. OBA increases that to 15 million, again, for that stock purchased after July 4th. Exchanges and rollovers do not qualify for this, unfortunately. It really has to be that original issuance of stock. Next is qualified opportunity zones. This is a great planning tool if you have sold investment real estate at a gain. Investing in the qualified opportunity fund can defer that gain to a future year. The old rules are that if you can defer that gain until you either sell the fund or December 31st, 2026. So coming up pretty quick here. Additionally, if you were to hold that investment for at least 5 years, you get a step up in basis of 10%, which is just another way of saying that you permanently exclude 10% of that gain. And if you hold it for 7 years, you get another 5% step up in basis. Now, under the new rules, kind of the second set of this qualified opportunity zone, the gain deferral lasts until you we're back on the other slide, until you either sell that property or 5 years from now. So there's not a specific date, it's just 5 years from the investment. The step up rules are similar, except that 5% step up has been eliminated at year 7. New though, the opportunity zones are really focusing on rural areas now. So that's areas with less than 50,000 people in the population. So we've got a lot of rural areas around here. If you're considering building there, you'll really want to look into this. If it's in a rural area, that's a 30% basis step up after 5 years. So pretty big deal. Additionally, if you hold that fund for more than 10 years, any appreciation that you see there is tax-free. And OBA holds that, except there is a caveat. If you hold that fund for more than 30 years, anything after that 30-year mark, any appreciation is not tax-free. So it's kind of an incentive to sell before that 30-year mark. And now these rules are permanent, so that should provide some certainty to investors that this will be around to use as a planning tool. There's also the new markets credit. This is a credit that is temporary but regularly renewed by Congress. And it's geared really towards low income census tracts, real estate projects, community facilities, operating businesses going into these low income areas. OBA retains this credit. However, it expects alignment with opportunity zones. So you should be able to use the opportunity zone tool and this new market credit for the same investment. Also, it's permanent, so you can count on that being around for a little while. And here too, they're really focusing on rural areas. So we expect those rural area projects to get some preference. And what this means for you, if you have C corporation stock or you're starting a C corporation, there's a more flexibility for who can qualify for the exclusion, and also provide some more flexibility in exit timing. Qualified opportunity zone, there's more certainty because it's now permanent. But one thing to note is that there's tighter eligibility criteria and significantly more reporting requirements with substantial penalties. So you really want to make sure that you're working with the right professionals to help guide you through these steps. You want to cross all your T's, dot all your I's. And we're happy to help you, talk to you about this if that's something you're interested in. And same for the new market credit. We've got some permanent certainty there. And also we expect this to integrate with opportunity zones and LIHTC. So it's some great opportunity there, especially if you're going into the rural areas. There are some international provisions. We didn't really touch on that too much, but just there are some higher effective rates because of reduction of deductions. And we're also not seeing any retaliatory tax regimes as of now. Just a small bit about that. So now we have state and local tax considerations. The pass-through entity tax election, that was something that came out of the TCJA. As Molly talked about previously, the SALT limitation was at $10,000. And this really didn't allow owners of pass-through entities, partnerships, S corporations to deduct the tax that they paid on their business income. So states found a workaround for that so they could pay that tax on the business level and get that deduction in full. 36 states have adopted similar rules. Wisconsin is one of them. So it was an effective planning tool for owners of profitable pass-through entities. Now with OBA, with the SALT limitation going up to $40,000, subject to limitations, excuse me, this planning tool may not be as effective for certain taxpayers. So it's really a facts and circumstances situation. You'll want to pay attention to, you want your tax professional to pay attention to if this is actually saving you tax dollars. Especially if you are a multi-state taxpayer, you could be looking at extending your tax returns come March due to some of these states having expiration dates on these rules. So we're waiting to see who extends these rules to beyond 2025. The other thing you want to pay attention to is the state conformity to federal tax provisions. Some states have a rolling conformity with the Internal Revenue Code, but others do not. So to be in line with the federal rules, states have to pass legislation. And we may not see that happen until after the filing deadline in March. So if you are a multi-state taxpayer, be aware of that. Be aware of a potential extending tax returns while we're waiting for these rules to come down. On the left, you can see some of the big items that we're watching to see how states conform. That's the research and development expenses, business interest, bonus depreciation, and some international tax provisions. So to recap, you really want to work with your tax advisor to make sure that the pass-through entity tax election works for you. This is still beneficial for high income individuals making over 500,000. And especially if you have a profitable pass-through entity and don't have many itemized deductions outside of the state and local income tax. Again, work with your tax advisor to make sure that they're paying attention to what states conform, and be ready if you're a multi-state taxpayer to extend potentially. Energy provision. So we lost a lot of our energy credits, almost all of them with OBA. A lot of them terminate before or by the end of this year. So for the residential credits, those expire at the end of the year. So those, if you're putting solar panels on your home, or you're doing things like replacing doors, windows, furnaces, air conditioners, things like that that do qualify for the credit, you'll want to make sure that those are placed in service and ready to use by the end of the year in order to claim that credit. It is not enough to just be paid for, it has to be placed in service. Similarly with the commercial buildings, if you have a project going on your business building, you have a little bit longer for that until June 30th. But again, you want to make sure you're working with the contractors to make sure that those projects are completed by that date. Electric vehicle credits, those are gone at the end of the month. If that was something that you planned on utilizing either personally or through your business, the time to do that is now. That vehicle has to be in your possession and usable by the end of the month in order to take those credits. There's also a new energy efficient home credit. If you're building a new home that's energy efficient, you have it until the middle of June of next year to complete construction. There's a couple other credits. The alternative fuel refueling property, you have until June 30th of next year. And then the clean electricity production and investment credit. While it previously had no expiration, now it terminates at the end of 2027 for wind and solar facilities, and after 2032 for all other energy credits. So with these credits, it's important that you're working with your tax advisor to make sure that the amount of investment that you're putting into these things actually qualifies for credit, and that they will be completed, the projects will be completed before the termination date of the credits. Additionally, if you have any foreign ownership in your entities, you want to review your organization charts and make sure that you still qualify for these credits. That's the end of our presentation. I would like to open it up to any questions that you might have. Well, we're happy to talk to anybody if you think of a question later or want to talk through any of these items. We love talking about this stuff and love helping people out. So if you have a question, please reach out. It's been an honor to speak in front of you today. Thank you for having us. And we look forward to hearing from you with any questions or items you want to discuss in the future.
Thank you very much, SVA. Really appreciate all of you.
Thank you.
Yeah.
Thanks
All
for
right,
having
bye.
us.